Alright guys, welcome back to the Daily Stock Market Digest. So today we are diving into a particularly confusing market landscape where the old saying, bad news is good news, is being put to the test. So what we saw yesterday was the market started up going high, but towards the end of the day, it actually closed red for most of the tech stocks. So we have a lot of noise to filter through to find the real signal. So without further ado, let's get into it. First off, let's start with how the indices performed at the end of yesterday. So looking at the final tally, right, you can see there is some sort of divergence happening. While the blue chip Dow managed to eke out a little bit of gain at 0.1%, the broader S&P 500 and the tech-heavy Nasdaq were firmly in the red. So this probably suggests a rotation towards safety rather than a broad-based market rally. However, it's also important to realize that this wasn't driven by exuberance, but rather by investors that are hiding out in reliable, massive industrial blue chips NIM as the rest of the market falter. So what exactly killed this momentum? It was actually the retail sales data, the consumers, because what we saw was that the December retail sales data dropped and it was a flat line. And if you consider that December is the holiday season, right, where people want to purchase more, so this is the reason why it was a little bit concerning. There was a 0% growth month over month, even though Wall Street and the market was expecting a growth of about 0.5%. So when you strip out autos, right, it was still flat. And this is critical because consumer is the engine of any economy, especially the US economy. And right now, through this retail sales data, we can see that the engine is kind of sputtering. So this reignite a little bit fears about some levels of economic stagflation. And this quote perfectly captures the tug of war that we saw yesterday. Investors are cheering for some sort of weakness because it implies that the Federal Reserve will cut rates. But yet at the same time, they are simultaneously terrified that a weaker consumer data will eventually tank corporate earnings. So what we see now is like a delicate tightrope, right? And often contradictory thread for everyone to navigate. So we cannot overstate how important this is because for months, right, the market had to rely on consumer resilience just to justify this high valuation. And if we see consumer sentiments or data finally tapping out, so the narrative of a soft landing become much harder to defend, regardless of what the Federal Reserve does next. And to make matters worse, right, what did we saw? We saw pressure in big tech, specifically Alphabet, which is Google's parent company. So they actually dropped close to 2% yesterday, and the main reason was because they actually announced a massive $20 billion bond sale. So when a cash-rich company, right, raise that much debt, right, the market starts to reach between the fine lines. Basically, the cost of building AI infrastructure is getting more and more expensive after we've seen most of the Mac 7 actually increasing their AI capex guidance for 2026. So this is in a way the same fear that we saw last week of people concerned about the margins moving forward. Now, here is where the bad news is good news logic kicks in. Because retail sales were so weak, right, the bond market immediately priced in a higher chance that the Federal Reserve will have to cut rates to save the economy. So that's the reason why we saw Treasury yields tumble a little bit. The 10-year yield drop to roughly about 4.14%, like what we will see. And the market is effectively booing the Federal Reserve right now. And following that retail data as well as the bond market, we also saw the probability of a March rate cuts jump to roughly 21% now. So a day ago, it was just 17%. So we actually increased by another 5%. Now, the baseline is still for the Federal Reserve to hold until June. But if the economy keeps showing cracks like this timeline will probably accelerate. Now, in the crypto world, right, this fear is also cascading there. Bitcoin is under pressure. I took this screenshot earlier, but I think that now Bitcoin is close to 67K and Ethereum is actually below $2,000 now. So on top of that, when we look at the sentiment index for crypto, we are actually at extreme fear at a rating of 9. And this was even worse than what we saw in April last year during the Trump's Liberation Day tariffs. So when the macro picture gets muddy, right, risk assets like crypto are often the first to get sold. off. So that is the macro picture. And let's move on. Let's shift gears to take a look at the corporate earnings that reported yesterday, and it moved the market slightly. So there are three distinct stories over here. A warning sign, a wonderful success, as well as a mixed bag. Now, the first one is S&P Global. So S&P Global, yes, they are the S&P. They are for the S&P 500. This is the same one, but what they do is they sell financial data. So their outlook is a proxy for the whole industry. And they actually beat their revenue at 3.92 billion, driven by their rating and indices business. But the stock actually dropped 6% on weak guidance. So this was what we shared yesterday as well, right? That markets are forward looking. If the guidance is not good enough, they will sell it down. So their earnings were expected to be 19.4 to 19.65, but Wall Street was expecting $20, as well as there were growing investors unease over AI disruption in their business. So we saw their shares being pushed down to their lowest in actually more than 2 years. So they are grouped within the broader software and services sector because its core operations, right, actually rely on very heavy proprietary data sets and advanced computation too. And as we know, the market hates uncertainty, and S&P Global actually just serve up a massive plate of it. Now, for the winner, right, the massive win is actually Spotify, which I'm sure a number of you will probably have subscription, including myself. Now, if you want to see what execution looks like, right, this is it, right? Spotify actually surged to over 15%, and they delivered a triple beat: earnings, revenue, and users all crossed expectations. You can take a look at how they actually added a record number of users. The monthly active users are up to about 750 million, right? You can see, let me move aside, right over here as well, 751 million. And CEO Daniel actually said that this is the year of accelerated execution. And the market loves this, right? Because it proves that consumers are not canceling their music subscription, even if the economy is getting tight. So you can see that discretionary spending is in a way still at some sort of levels that are good for the economy. Not entirely bad, but good. So now we can see Spotify is more of a staple because there is no other solutions or other better options as well. So that probably led to why they had a record number of user growth. And finally, the mixed bag, Robinhood. So Robinhood had actually had a record year overall, but their Q4 results actually left investors hanging dry, right? The shares dropped close to 8% in after hours trading, and honestly, they actually beat on earnings due to cost cutting, but they miss on revenue, right? They actually miss on revenue. So and the revenue actually came in at 1.28 billion versus the expected 1.34 billion. And the culprit, as we all know, is because of the slump in crypto trading volumes. So Robinhood actually relies heavily on retail traders that are gambling on crypto volatility apart from stocks volatility. Their story go way back from 2020, from the GameStop saga until today. So when Bitcoin goes down, you expect Robinhood to also go down, right? And even though the CEO Vlad is actually pushing Robinhood to be the financial super app narrative, so credit card, futures, prediction markets, everything in one place, but the guidance actually shows their operating expenses rising 18%. And you know, right now, especially when we are hearing about AI capex increasing, right, investors don't want to hear more about rising costs. So they want to see revenue growth, and this crypto slowdown is actually a headwind in Robinhood's business. So what's actually coming up? Moving on, after we've looked at the earnings that happened yesterday, what is coming up next? So a few things. On Wednesday, tomorrow, this is not going to be a normal Wednesday. We are going to have the first jobs report of 2026 on Wednesday. And this is basically the non-farm payrolls, and we usually get that on the first Friday of the month, but there was a partial government shutdown that actually delayed it. So it's going to happen tonight at 8:30 a.m. Eastern time, and the consensus is for 70,000 jobs. But if we come below that, below expectations, right, this will be kind of add on to what we saw on retail sales, and the calls for a March rate cut, you can see the probability will adjust again. But if we get the other end of things, which is a shock bid, like let's say over 100,000 jobs, right? So it's probably going to confuse the narrative, and it might likely hurt stocks because it takes rate cuts off the table. Okay, and don't forget that apart from just releasing the non-farm payrolls for the previous months, this Bureau of Labor statistics can also adjust and revise the previous month. So the markets will be paying attention to that as well as we look at this new data history. Now, another one that's also coming out today, which is unemployment rate. This is one of the things that the Federal Reserve look at for their dual mandate. Okay, at the same time, it's going to be announced. Markets are expecting it to be unchanged at 4.3%, and if we see it creeping up higher than 4.3, markets might see it as an economic weakness. Why? Because if interest rates are down, you will expect that companies will be spending more and unemployment will decrease. So if you see it higher, it's going to be very tricky. But if unemployment is lower, that is where we might see strength in the markets. So it all comes down to how it shifts expectations for Fed policy. So these are the two numbers, the non-farm payrolls and the unemployment rate, that we got to monitor like a hawk. Now, some of the earnings that are actually coming out today on Wednesday, which is a few things. Number one is McDonald, right? So for McDonald, right, is every one of our favorite food. Okay, so why is McDonald important to keep a close eye on? What we are looking for is this thing like what we call the trade down effect. Okay, so if people are moving from restaurants to McDonald, to those fast food restaurants, for example, like McDonald, right? This is where they will thrive. But even if their sales are dipping, it's a sign that the lower income consumer has reached some sort of breaking point. Now, we also have Shopify, and Shopify has been beat down rapidly recently because of all these software stocks, and even right now, because the stock is oversold, even the earnings that is not super strong, they could spark a relief rally. In fact, that is actually what we saw for Spotify. They actually got beat down over the past few months, but because they had a very strong report, that actually caused a very strong rally. So for Shopify, this will be their report, their earnings will be a primary read of how e-commerce is faring compared to the typical brick and mortar retail numbers that we saw yesterday. We also have other companies like Cisco. So Cisco will also tell us if the AI boom is actually moving the needle for hardware. You know, we know that everyone is buying NVIDIA chips, everyone is buying AMD chips, but Cisco ballot will show if companies are actually building out that infrastructure to connect those chips. So in a way, it's a vital enterprise health check. Okay, other companies that we have HubSpot as well and AppLovin. So these are the companies that will give us an inkling of how the AI movement is going on for all of these companies as well. So that's all that we have for today's Stock Market Digest. So be sure to hit that like and subscribe button as I publish a new video every day. And I'll see you in the next one.